Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. This week on the podcast, we're taking another look at the very interesting private equity sector of the investment trust universe. We've already spoken recently to Jim Strang at HG Capital, very different kind of vehicle to the one we're talking to today. And that trust in focus is Oakley Capital Investments, a very interesting and differentiated trust in the investment trust sector. I'm talking to Steven Tredget, who is a partner of Oakley Capital, which sourced and manages this particular listed private equity trust. It has, just to put a little bit of context around that, Oakley Capital has a market capitalization currently of around 940 million, trades at a discount of around 23-24%, but it ranks very highly in the ranks of 5 and 10-year performance, where it's in the top 3 in both of those categories, even including 3i. So, Stephen, let's just begin, as we often do, by giving listeners a chance to quickly recap what it is about OCI that is different from other listed private equity and what your main focus of activity is.
Thank you, Jonathan. Thanks for having me back on the podcast. So to recap, Oakley Capital, as you say, is a private equity manager. It's focused on the small, mid and mid-market, so small to medium-size private businesses here in Europe. And it's focused on taking majority controlling stakes. The key differentiating factor about Oakley is its founder focus. And that may not sound like a particularly devastatingly different kind of approach, or that would somehow be the DNA that's produced the returns that we produce, but it is. We were started by an entrepreneur some 20, 25 years ago who set out simply to establish the backer, the financial partner that he was never able to find for himself. And so in forging a relationship or reputation for ourselves that we are the investor of choice for founders, we've been able to kind of produce outsized returns. And why is that? And I guess, first of all, it's because we're backing incredibly successful, proven founders. And some we go on to back 4, 5, even 6 times in one case. So we stand on the shoulders of some of Europe's most successful entrepreneurs. These are businesses that are already high growing, they're already profitable, they are going to continue to be so with or without us. But the founders are looking to bring in a partner to help them do a range of things that are probably beyond their ability. So, that may be M&A typically. They want to expand their product or the geographies in which they're in. They want to bring on more talent. They want to understand and grasp AI better and a whole range of digital solutions. And not least, they understand that their business, while it has been incredibly successful and is fast growing, needs to do a lot of operational, organizational maturity. So as you can imagine with a founder, they're focused on a lot of things about growing and sales and their product, but actually there's a heap of other stuff that they need to think about as they get bigger, so they don't overtrade or grow to be. They probably have a messy shareholder structure. They may have a poor cap table. They may have poor reporting. They may have very little of any kind of proper accounting. They may not have a good grasp over their capex, the return on that capex. And as I say, there's a bunch of other ambitions that they may have they simply can't achieve. And so that, in a nutshell, is what we bring to the table. 75% of our deals to date have been founder-led. 50% of the companies we've backed have been introduced to us by founders. And 90% of all the deals we've done have been outside competitive processes. And that's key. That kind of demonstrates the fact this is founders who are letting in a private equity investor into their ownership, the ownership of their equity, for the first time, the first institutional capital coming in. That's very important. We're rarely buying from another PE firm. And so they are taking that decision with incredible caution. And their key decision-making point for them is who is going to be the partner, who's going to work with me to develop the next stage of the business. It's not price maximization. And that's key. So we're often getting into really exciting businesses, unseen gems that need that kind of polishing over our 4 years of ownership. And we're also doing that often below market prices. And those founders, a real point of pride for us, go on to invest in the funds themselves. So about 350 million of the funds we manage are actually from the founders who have gone on to invest.
Okay, so when you just pick on one point there, you talk about it's not price maximization. What you actually mean, just to be clear, is that they are not necessarily trying to get the best deal when you come in to get involved. They want to get you in at that stage. But after that, presumably you wouldn't say that what you're interested in is not price maximization.
That's very true. You're absolutely right. I mean, our job then is to improve the quality of the earnings to help grow sustainably the business. The business is already growing. It's our ability to kind of take it on to the next stage and prepare it for, to your point, the ultimate sale to what is typically either a key strategic company in their particular industry, or it's to one of the large global PE houses. And our last 8, 9 deals have been to those large PE firms who often, in some cases, may own a strategic and they want to kind of combine the two. And you're absolutely right. At that point, if it's exactly what the founder wants to do as well, we have to be aligned, then that's exactly what we're trying to achieve.
So what is your typical holding period then, from starting with the hand-holding stage and then going through to passing them on to a larger, perhaps a private equity firm, which may not be quite so understanding as you are?
Typical hold period is exactly that, just under 4 years.
Right. So that's a relatively short period in which you're involved in the business. Typically, what kind of returns are you targeting or hoping to make? And we can then talk about what you have actually made, but what's the sort of target when you go in?
So with every deal that we make, we have to get a return of 2.5 times gross, 2 times net, essentially, or 25% IRR net. That's our base case. And then in reality, if you look at our realized returns, we've probably just made just shy of 4 times money multiple and a 40% IRR.
Well, that's pretty impressive, obviously, if you can achieve those numbers. But presumably you don't achieve them all the time. Well, we know you don't because we can see the results of the trust itself over time. I mean, over time, I think you have talked about making 20% compound returns. More recently, it's been a little bit lower than that, I think it's fair to say. And is that primarily a function of what's been happening in the private equity cycle, or is it actually wider industry factors?
Yeah, I mean, to put that in context, so our 5 year return is about 124%, which is about 17, around about there, compounding annual return. So we're still in that ballpark. And to answer your question, why is that running slightly behind? I think it's a combination of factors. Firstly, there are, and there has been, increasing headwinds as a result of macroeconomic or geopolitical, many of which were described as unprecedented, but we seem to get, one a year in some shape or form since kind of COVID onwards. And so that's naturally produced a certain level of disruption and headwinds to the businesses. And yet, despite those, the companies have consistently continued to grow. They're growing organically around about 15% earnings growth, or just over 20% if you include M&A. So I think it's been quite a defining period for the listed private equity sector in general, that they've managed to grow as they've done and proven that their valuations aren't fantasy, but are actually quite conservative. We're selling assets above that kind of valuation point, and we're proving that we can grow these companies even in what is a relatively stagnant, if you like, kind of broader economic environment, which has been teetering on recessionary for the last few years. You mentioned quite rightly that the exit environment hasn't been as buoyant as it may have been 2, 3 years ago. That is certainly a factor in kind of unexpected approaches for the companies. And if we go back to, let's say, 2022, kind of coming out of COVID, maybe in the years prior to COVID, we certainly were receiving a lot of bids for businesses maybe a year or two before we're going to sell them, unsolicited, who were offering us, particularly big premiums. And that was for a number of our portfolio companies. That has definitely slowed over the last couple of years and will definitely have slowed that kind of unexpected, but was typically happening kind of annually bump to the NAV per share. Despite that, we sold 3 businesses last year. We've sold VLEX at a 300% premium this year. So you're still, even in a kind of more muted market, you're still seeing exits, and you're still seeing exits at a premium to the net asset value.
But as you implied just earlier, I mean, most of those exits are to other private equity firms. Is that right?
A mixture, yeah. So VLEX was sold to a strategic player in the broader legal software space. And the three companies before, I think two were to PE and one was to a strategic.
Right. So let's sort of put one thought out there. I mean, some people think that a lot of what's been going on in private equity has been passing the parcel from one firm to another because they can't get the liquidity that they're used to. And the whole cycle has gummed up a bit because they can't raise more money until they've realized more and so on. What would you comment about that? Has that been going on?
Well, there certainly is a certain amount of indigestion in the market. And I guess that the proof point for that is the average hold periods within global PE have been increasing. There's varying stats on this, but it looks that at the very least, it's kind of gone from like 5 to 6 years to 7 odd years hold periods, which would suggest that's the case. Where you see that greater indigestion is in two ways. One, it's in the larger kind of bulge bracket, and that's because that is the group that would have typically used the IPO market for exit, which of course has been much more subdued for new issuance in the last handful of years. The other kind of category is where, if you don't have an A plus outstanding business, where uncertainty in the market is going to cause a kind of differing opinion between buyers and sellers, then you're going to struggle to find an exit. Where the market has done well to really hold on to its best assets is where they've now launched more of these continuation vehicles, which are basically designed so that the management or founder of a business and the private equity firm can continue to back each other. And they've kind of launched funds designed for specific assets. In the main, though, I mean, we've seen it. Our average hold period has barely changed over the last 5 years. It's still been around this 4 year point. Great assets have continued to find homes. I mean, it doesn't really apply to us, but I philosophically feel that there's a bit of a red herring, this idea that private equity firms buy from private. It's like saying people with houses buy from other homeowners, or in the public market, fund managers buy from other fund managers. That's a market. You buy and sell assets between you. And there is a need to sell an asset and buy an asset because in private equity, you have funds with a limited life. You invest over a number of years, maximum 5, and you harvest over 5. And so there is a need to sell an asset on. And you've got other private equity firms that are specialists at taking on companies at another stage. So whilst there definitely is indigestion, I think this concern of trading assets within the private equity world, which is now in excess of 20 or trillion, it kind of sounds like it's a bad thing, but that's a marketplace. It's exactly what you expect to happen.
Well, at least you're able to do the deals that you need. I mean, just looking at the run of NAV total returns over the last 5 years, these are 12-month periods, up to date. And it's sort of 2021, 17%, 21, 22, one of the period you were talking about, 60.7%. And then since then, 3.9%, 2.7%, 6%. So that 3 year run has been a step change in the order of magnitude of the NAV total returns. Obviously, the share price has done better than that because the discounts come in. But I guess the key question for anybody looking at the trust today, how quickly can you get back to the kind of NAV total returns that you've achieved in the past, in other words, to take you back up towards that long-term record?
Yeah, as always with these numbers, there's a kind of story behind some of that. And then the 60 odd percent year, one of our biggest assets was sold the following year at book value, but it was increased in the prior year because we knew it was going to be an exit book value. So there will be some smoothing in reality. Also, which is the kind of case for this market, is that we've had an incredible opportunity to make investments. Bear in mind, we're a focused investment. OCI gives you ownership in about 36 portfolio companies. It's not a huge number, and you can get a lot of detail on each of them. We only do 6 to 8 deals a year. We've looked at year to date 4,000 opportunities. And for us to look at it, they have to have reached a certain score, reached a certain quality threshold there's 20 points that we look for any company. So there's a wealth of opportunity because, of course, public markets not functioning, there's high cost of debt, and there are a bunch of other push factors where founders are facing increased cost pressures elsewhere, or there's greater regulatory guidance they need in a more complex landscape. There could be a whole heap of reasons, but there's a huge number of opportunities. That's led us over the last few years to deploy reasonable amounts of capital. And actually, if you look back to last year, about 50% of our NAV was not going to change that year. And why is that? Well, a certain amount of it was cash. A certain amount of it was a preference share. which at the time had a zero coupon. And then the majority was companies we bought in the last 12 months. And we typically do not change the valuation of a business in the first year. In fact, there isn't a huge amount of change in the first few years. So when you have a slightly less mature portfolio, generally speaking, your NAV growth will reflect that. As I say, 50% not changing at all. What tends to happen is first year, you put in months, you spent millions on due diligence in these companies, you've established a price. You're not going to start marching that price up within the first 12 months. Unlikely. In the next 2 years, value creation starts to take place, as it does over the first couple of years, but we will rarely change the multiple, which should be a conservative multiple, unless something negative has happened. The reason and the majority of the growth during the first 3 years version will be earnings growth. If the earnings grows and the multiple stays consistent, then you'll see some valuation growth. In the fourth year, typically, is when you might see multiple expansion as we start to mark the company more closer to the market, because you're moving into this is the environment in which we're considering selling the business. And therefore, you see that accelerated growth in the valuation as it prepares itself for sale, because typically we're holding these businesses below where they trade in the market. The evidence of that is that on average, we sell a business 30% above where we're holding it. And that's the right approach to take, because you don't know until you go out there and sell a business what that business is going to be worth. You only truly know what business is worth is when you decide what you're going to pay for it and then ultimately what you sell it for. In between, you're making an estimate of that. And we try to make sure that estimate is conservative and reflects the broader market these companies are trading in.
You said that was interesting. I hope I haven't inferred this incorrectly. You said that you looked at 4,000 deals this year. Is that a way of saying that actually the number of opportunities you're seeing that score highly on your initial scrutiny of the market is higher than normal? Was that the implication of what you were saying on why you've committed more in the past couple of years, because you're actually finding more opportunities? And if so, why is that? That just seems a little bit at odds with the kind of macro environment out there.
Well, I think the reason for the sheer scope of opportunities is because we are one of the few sources of funding, private equity in general, because of Oakley's position within the market and in terms of our reputation and the kind of thing we're doing. So when you get dislocation in the market, there becomes a real opportunity for growth companies to take advantage of that, particularly through M&A. So there's a number of triggers that have thrown a lot more founder-led opportunities up. In the meantime, we've got new funds to deploy, funds that OCI has committed to, and you would expect us to be deploying bigger numbers as we get bigger. And then, of course, we have more sources of deal flow now. You know, it used to be often very reliant upon the founders. Then we have a growing team, a team of about 100 PE professionals who are mapping the market to find opportunities in the sectors that we particularly focus on, so kind of technology, education, digital consumer, and business services. And then you've also got an origination team whose job it is to engage with advisors to make sure that we're on the list for any great deals. Now, that's the reason for the bigger pool of opportunities. If we find great opportunities, we will potentially deploy more in 1 year than another. You might have a very strong couple of years of deployment, and then you may not find the opportunities in the next year. You don't get a linear deployment over the life of a fund. And in some regions, UK, for example, if you look back a few years, we really didn't find any opportunity in the UK. We didn't find the price, we didn't find the growth, and we didn't find the founders we want to back. That happens to have changed in the last couple of years. We've been able to back some really impressive founders in Steer, an automotive repair company, Fenner, a testing and inspection business, and Assured Data Protection, which is an incredible cyber attack recovery business that essentially allows companies to restart themselves up virtually as if the cyber attack hasn't happened. And so we deploy where opportunities exist, and you will see fluctuations in that deployment.
So perhaps another way of looking at that is through the amount of commitments that you have, which looks quite extensive. I mean, it looks a large number. And when you look at your available cash and debt and so on, you might raise a question about how you're going to fund all those commitments. Is that a fair question to ask?
It's absolutely a fair question to ask. Yeah, I mean, on the surface of it, you make a great point. You know, roughly, crudely speaking, you've got kind of 1 billion of outstanding commitments, and that compares to about 1.3 billion of existing assets. So from that perspective, that looks quite a big outstanding kind of liability. And so this is when we say commitments have been made to the funds that have yet to be drawn. So it's undrawn commitments. Now, in reality, of that number, probably it's more like 300 million of that number that's unlikely to be drawn. And why is that? It's because this isn't like a public equity fund where you can deploy right up to the amount you need to deploy. Here, there's a couple of things. One, you only make 10 investments. There's a certain amount of equity that's available in those investments, and you're very rarely able to deploy it beyond 90% of a fund. The other thing that is best practice as well is that you keep some contingency. It has rarely happened to us, if at all, but against the fact that you're the majority holder, if something goes wrong within that business and you might have to provide it with extra unexpected capital, well, then you need to have contingency in order to do that. So it's 300 million we won't deploy, or it's unlikely to be drawn. So then there's about 575 that's going to be called over the next, after a year and within 5 years. So that will be deployed steadily over that period of time. And then in the next 12 months, there's a kind of couple hundred million. And so that's the number that we tend to focus on, is what's going to be drawn down in the next year or two. And we like to broadly have somewhere in the region of a year and a half, at most kind of 2 years of cover, such that if we don't sell a single asset over that time, we've got enough capital to meet the drawdowns from the funds. And that's broadly, with the liquidity you have through cash and available debt facilities, we've got that level of cover. Now, in reality, Oakley tends to sell actually slightly more assets, and so provides proceeds that are slightly higher than its drawdowns, typically over the course of its history. That's not to say there isn't a market where that isn't going to be the case. And if we look at Oakley today, we've had recent proceeds from a number of deals that are going to be coming through in the next couple of months. So the refi that's just taken place, so that will produce more proceeds. And there's probably another 4 companies where advisors have been appointed, and we would anticipate the potential for realizations over the next 12 months.
So if I can put words in your mouth, you're basically covered to the extent you normally are.
Yes.
I mean, of course, things could go wrong. There could be some sort of recession going on, and that would be tricky, would it not? Because your companies might need more cash in those circumstances. That's the kind of contingency you have to allow for, right?
Well, we always anticipate that these companies, we're going to own them in a recessionary environment. So when we model that base case out that I referred to earlier, we assume they're in a, let's say, 90s style recession. There's a relatively high cost of interest. There's a limited amount of M&A. And so it's rare that we have to kind of put support capital into these businesses. What you tend to find in reality is deals don't get done, because what you tend to find is you can't sell a company, you also can't buy a company. If you think about extremes of that global financial crisis, which is actually when OCI listed and it raised first capital, it was almost impossible to do a deal. There was a big disparity in valuations. Banks held onto businesses rather than sell them at discounted rates, and the debt market froze up. And so actually you find that nothing happens, as opposed to we buy lots of businesses and we can't sell any businesses. But in the main, the cash flow is analysed on a monthly basis, ensuring that OCI is in an appropriately well-financed position to meet any drawdowns as they come. The underlying companies as well, which is where previously PE has got into trouble, aren't heavily geared. And where they are geared, they're geared where there is a high level of recurring subscription-like revenue. And so again, one of the reasons why these businesses are really resilient is that they're designed to grow, or they're expected to grow, regardless of what's happening in that macro environment, because there's some kind of disruption. Like digital disruption means that, I don't know, let's say price comparison in Italy, there is a greater adoption of price comparison because there's a very low penetration of that solution. I often quote the number, but let's say 15% of car insurance is arranged digitally online in Italy, versus 80 to 90% in kind of Western and Northern Europe. And so you're not taking a bet on car ownership or insurance premiums. You're taking a bet on the fact that more Italians will use an online solution, which has been the case for the last 10 years. And that solution has grown 20, 30% every year. Education, it's one of the last things that a parent will give up is their child's education. Or we have lower cost digital education solutions, which we know will thrive in a recession.
You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. Okay, so let's look at the investment trust itself then. One of the things that's happened obviously over the last 3-4 years is we know that discounts got very wide in the listed private equity sector. I think your own went out to about 40% at the lowest point, but it has come in quite significantly since then to around 23% now, I think. But of course, in the process of that, we've had pressure on the boards to actually introduce capital allocation policies and explain more clearly how they're allocating the cash that they do have between the options of investing more or returning capital to shareholders or paying dividends or whatever it might be. Can you just explain what Oakley Capital's approach to this has been? I mean, we know that you've given up on paying dividends and you've been concentrating on share buybacks within an overall picture of capital allocation. What is the sort of general approach and why does it take the form that it does?
Yeah, on the dividend point that you make, well, one, we're not an income generator, we're capital growth. We introduced a dividend because at one stage, and we're going back 10 years, we had a number of large income fund investors on the share register. That's gone. And in consultation with the shareholders, none of them were really particularly enamored by the dividends for a range of reasons. And the much favored method of capital return is share buybacks. I think we view the share buyback as a way to take advantage of the mispricing of the shares. So it's an earnings enhancing move. And if we have excess cash, i.e. cash over that kind of level of like 1.5 to 2 years of cover, then we've been very keen to return that. We set a minimum annual buyback of £20 million. And then if we have sight to greater cash levels, or the board, more importantly, has sight to greater cash, then it will look to increase that. And to that end, with the realization that took place in the first quarter of this year, the board increased the buyback this year from £20 million to £50 million, which the company's been in the process of acquiring and cancelling those shares. They're roughly up to about £40 million of the 50 million. So there's circa £10 million of shares they'll be buying back over the course of the next 4 weeks. In terms of the discount closing, which I'd argue is to some extent a different challenge, there's a number of ways that I see that closing, and that's some that's in our grasp and some that's not in our grasp. I mean, one of the things that's clearly happening is there's a shrinking supply, not just through buybacks, but because there is a burgeoning secondary market and evergreen market where billions and billions are being raised in that market, and there is a demand for positions in funds of high quality managers, of which Oakley is one. Apax were recently taken out by a secondary fund, and there's a lot of speculation around would we be someone that would come next. And there's a lot of secondary interest in owning fund positions like OCIs in Oakley's funds, and we could very easily be taken private at NAV now just to take the gains of closing the discount. And if you were entirely short-termist, that's exactly what you'd be. However, I think the board's kind of view is that there's much more value to be created in continuing to perform, committing to the funds and creating medium to long-term returns. And with that consistent performance, with the scale that that brings, with further exits at premiums, by going out there and increasing the knowledge and understanding and the transparency and communication that we can bring to the listed PE market, that will continue to see us rate. And we get one of the benefits of being one of the last direct PE listed investment companies standing. There are only 2-3 of us left, and will increasingly attract the capital that wants to invest in high quality managers. And so our ambition is to be a FTSE 100. We joined the FTSE 250 about midway through the table in August. And we believe we've got the performance and the ambition to achieve that. Now, in the meantime, other things will help drive that, particularly the fact that Apax will not be the last listed investment trust that's taken out.
Well, indeed, you're probably right about that. But are you telling us that there is still something worthwhile about being a listed private equity trust rather than going down a different route without all the hassle of all the regulation and all that stuff, and of being a listed company, and of course having to manage this discount issue, which is an issue in enough people's eyes that it's become an issue more globally, shall we say.
I think it's a great philosophical question. I think the two answers are firstly, yes. So, does the board of OCI believe it can deliver a long term return well in excess of the FTSE All-Share or the MSCI consistently over time, as it has done, and therefore provide a valuable asset class or investment type for retail institutional investors? Absolutely, it does. Firstly. Secondly, I think philosophically, we think it's really important that, and this is what OCI and a handful of others provide, democratizes that access to private equity. Private, whilst it may only be 20 trillion odd in total global value, the pool of opportunities that are still private, 2/3 of global corporate revenue is in private hands. If you look at Europe alone, if you look at companies with over 100 million of revenue, 96% of those are privately owned, and the majority are still in founders' hands. And the public market more broadly is failing as capital flows out of it. And so this is a perfectly formed, well-governed, great way for investors of all types who maybe don't have the scale required to be able to buy into a private equity fund, nor want to tie up their funds for kind of 10 years. This is a great liquid way of getting access to that class. So it fills the need and it produces a great return. The discount point, Jonathan, look, I believe it will close in time, and there's measures that the boards and boards like us will continue to take. And I think market forces will see supply reduced and we'll see demand rise as people get more and more interested in this asset class. The other point around the discount is, as you pointed out right at the start of the show, OCI has delivered top one, top two performance over 3, 5, and 10 years. Shareholder returns, the number that matters. It's done that in spite of having, throughout that entire time, a stubborn and high discount. The discount is the cherry on the cake. All people who bought these shares at a discount, and it remains the discount. But the NAV and the share price has grown over that time and has delivered first-class returns. Now, if the discount happens to close, that's great. It will boost those returns even more in any given year, but it's something we don't ultimately have control over.
But you do think that ambition of getting to the FTSE 100 is a further means to closing the discount. In other words, more liquidity, greater visibility, and all those things that go to that. And of course, more regulation.
The more an asset trades, the closer it gets to fair value. And I think that's exactly what will benefit OCI. Just shy of $1 billion. It's not inconsequential, but it's still a small, medium-sized business. And you've got a greater propensity for companies to misprice. I mean, largely, this is why we can get caught in the weeds of the specifics of OCI. The sector trades at a 2-3 percentage turns higher discount. Investment companies trade on an average 15% discount. There is a wider problem that is public markets and small mid-cap markets being mispriced. And that is exaggerated within investment companies and is certainly within private equity, where there's general kind of suspicion about pricing and valuations. But as we consistently, as a sector, demonstrate, assets are being sold above those valuations. There is a reasonably high turnover of those assets. And I think if we keep consistently delivering those returns and that liquidity, then eventually we'll rate accordingly.
You have put a lot of effort, as you mentioned before, in improved communication with the market, and you won one of the AIC awards for your shareholder communications recently, so congratulations on that. But in terms of your share register, can you trace us the history of the share register? So what percentage has been owned historically by wealth managers or other types of institutional investor, and what percentage by retail investor? And to what extent are you, like some other trusts, avowedly trying to recruit more private investors to the cause?
Yeah, we're on that kind of third phase of shareholder type. So we started off when we listed, and Oakley was very much a kind of club. It was like 10, 15 fund managers that had made money investing in the public companies the founders of Oakley had established. And so it was 15 fund managers who owned 100% of the equity. And that was pretty much the story up until about 2016, when it was recognized that the shares were particularly liquid. There was no real particular shareholder outreach beyond the kind of fund managers that existed. And there was kind of a little turnover in the shares. And then, as you might imagine, those investors, some leave the market. It was one of the smallest holdings they had, changes in ownership. And I think at one stage in 2016, we had the two biggest shareholders that owned 60% of the register, and the top 10 shareholders own 98% of the register. And so whilst there was arguably very good governance then, because you could talk to 10 shareholders and you've spoken to 98% register and they collectively made decisions, what you didn't have was a functioning share price. And so from that point, we set about making OCI a best-in-class investment company with all the reporting, the communications, and transparency that involved. And with that, introduced a new investor type. Those that basically saw, there's going to be a big change here. We can see a discount closing opportunity. And so that got a second wave of investors that came in. And then this third wave that we're kind of coming through is one involves a lot more retail investors than it's done historically. If I think about the number we went into COVID with, we had about 3% through the kind of main private trading platforms. Now, if you added up just Hargreaves Lansdown, Interactive Investor, and AJ Bell, they alone add up to about 16% of our register. You're also seeing some more of the wealth managers, those longer term investors and institutions that are coming onto the register now, who are natural owners of investment companies and put a lot more effort into understanding the underlying assets. You're also seeing some European investors for the first time, just outside the UK. And also, interestingly, some of those investors, like particularly family offices that we've introduced the Oakley funds to, who can invest directly into the funds because of their scale, are also seeing the discounts which OCI is trading, and also because they've got the flexibility when private and public, also buying the shares there. It's a much more diverse register. So if we look at the top 10 shareholders now, it's probably about 50% of the register, with no one owning any more than 6%. And as I say, the retail wealth and the wealth managers are now an increasing and growing percentage of the register. Who are we reaching out to? I mean, we are starting to kind of reach wider in both the context of, we feel it's our job not just to talk to those investment companies, and you're also asking them to kind of shuffle the decks and choose us over someone else. We think our job is to go outside people who don't naturally invest in investment companies, might not naturally invest in the stock market, and say, hey, here is an asset class you have to get exposure to. You can either get that through direct into a private equity fund, you can do it through an evergreen, or you can do it through the public market. Just do it in one particular way. And so it's our job to kind of explain private equity, to try to break down those kind of long-held negative views around some of the things you describe: over leverage, Ponzi schemes, asset strippers, kind of outdated and often very inaccurate general views of private equity, and particularly to private individuals, as you say, where we think it's important that anyone's portfolio should have an element of private capital in it.
And so where are you on that journey? Would you say you're
in the foothills?
You're at the foothills. Well, that's very interesting, because that sort of goes against, as you say, the kind of general views that people hold about the future of the sector. Can we just then quickly take on the issue of cost disclosure, which has always been an issue that comes up a lot in the last 2 or 3 years? We're still waiting for the definitive verdict on cost disclosure. Has it actually been a barrier? Obviously, it hasn't been a total barrier to you recruiting new investors. What are you hoping for there?
The barrier has come. I mean, there's whole areas of the market that has never invested in or rarely invested in investment companies, full stop. That's not really a listed PE point, although listed PE naturally has. I mean, net returns are high, but costs are high because these are big operations and lots of capital is spent to make an investment, unlike if you're a public equity manager where you don't have nearly the same costs. But if you talk to the AIC, I remember when we first joined the AIC, this is the one group of investors that will not speak to you as IFAs. And it's simply because they didn't want to have to explain to their underlying investor what this cost line was. And it didn't matter that it was essentially double accounting. It wasn't a cost you had to pay after your ownership. It was a an operating cost, a net cost, just like Vodafone has operating costs, and you don't get a line that says you own 10,000 shares of Vodafone and you paid them £10,000 of costs as your look-through ownership of the OPEX. I mean, it's nonsense. But I understand that from a wealth manager or IFA's perspective, they do not want to describe that line. They'd rather not have that line in there. And so as a result, they've kind of avoided investment companies when they can. To have them back in, or to help those funds that had to disclose a kind of look-through cost line, that will unlock a part of the market that hasn't traded. I think retail, I don't think they've ever paid quite as much money. If they're investing on Hargreaves Lansdown, yes, there is a page that, misrepresents the costs associated with an investment company like OCI. But that will not have deterred people that are going to buy shares in OCI. They understand the proposition, they understand the returns, and they're keen to own the shares. It's those where someone else is making a decision on your behalf, and therefore there is a lack of knowledge and therefore a perceived concern when you see a cost line you don't expect in your reporting.
We're getting near the end of our time, but we haven't at this point discussed anything about the portfolio itself and the companies that you own, except in very brief passing. But the thing that struck me, I think, looking at your latest third quarter results, there was quite a lot of volatility in the valuations, right? I mean, the double digit went up and a double digit went down, if I read that correctly, or at least over the last year or so as well. What underlies that? And are those idiosyncratic pressures or difficulties or opportunities, or is it just the normal state of affairs for a portfolio like yours? I would suspect not.
Yeah, I mean, it's in most cases, it's us trying to take a relatively cautious view when, in terms of when it's down on kind of future performance. You're kind of saying, look, why be wildly optimistic? Let's take a cautious view on that and on ratings, where certain sectors we may have seen ratings fall, like you might have seen maybe a softening in the software market. I mean, when we say volatility, we're talking relatively small adjustments here. Have looked through single penny per share changes that actually ended up in Q3, essentially a neutral outcome. The portfolio values and ultimately didn't change. But it reflects the kind of headwinds generally in the market. Also, when you're investing in businesses, you may suppress the earnings, of course, because you're putting more capital to work. I mentioned Assure Data Protection earlier. They're doubling their staff. We're putting a lot more cost into that business. Their run rate EBITDA growth is like 60% per annum, but will naturally have suppressed that in the first year of ownership because of a lot of the cost that's been going in. And despite the fact that that earnings growth will return, the valuation will reflect that because you have to do quarterly valuations. You can't go, well, it's not really dropped. We have a team that independently reviews and kind of attaches valuations on a quarterly basis, and they will mark them down accordingly. The one thing I'd say about those 36 companies, though, is that the outlook for pretty much all of them is really strong over the course of the few years planned of the ownership. We'll see some positive surprise, I'm sure, from the exits when we achieve some of those above NAV. And I think the NAV is so relatively conservative that there's plenty of white space between where these companies are trading and maybe where they might be trading on the public market. And as I say, they're in businesses where they're software as a service, where you've got this kind of contracted revenue. It's cyber, where you've got incredible market forces in cyber protection or cyber recovery. It's in education technology, which is an incredibly in-demand sector. And then you've got this overlay of AI. We have a dedicated AI fund that's backing kind of software companies with generative AI behind them, and an AI overlay, which is really transforming some of the companies like our online higher education business, which now has an AI teaching assistant, or VLEX, which has an AI solution that allows lawyers to build cases, review case law in seconds rather than what would have taken weeks, if not longer. So there's plenty there to excite over the next kind of year or two, alongside a re-rating in the shares, which we think will continue over the next 12 months.
So that was Steven Tredget, the partner of Oakley Capital, talking about Oakley Capital Investments, the listed private equity trust, with an interesting array of portfolio commitments, not least including, as he just mentioned, some exposure to AI, the emerging markets that are being created by generative AI.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.